Hello, it's Jonathan Wellham of Rocklink Investment Partners, and it's Saturday, July the 19th, 2014. I wanted just to take a few moments to update clients on some of our current thoughts in terms of the marketplace and our caution in regards to overall valuations. First, before I jump into that, and I have 6 slides that I want to walk you through, I just want to mention quickly a little bit about headline risk. We talk about headline risk in the financial markets. We're talking about events that are taking place in the world that can scare investors and cause increased volatility in the marketplace. The situation in Ukraine with the downing of the jet and sort of the results of that and what could occur as a result of friction between countries. The situation in the Middle East, which is very concerning. And these are issues that will rise from time to time. We don't know the outcomes of these events, but as investors, we know that we have to invest through events like this. And we have to remain cautious, but we also have to be in the game and continuing out to allocate capital despite these challenges as a result of the world that we live in. Now, I also just want to point out when you have events like this taking place, it's important to invest in high quality assets. As we've pointed out repetitively for our clients, we are in a world that is facing some real monetary challenges as a result of the indebtedness of individuals, corporations, countries, and the record low interest rates and the challenges that is going to continue to present as we try to get out of this mess that we've created. And therefore, as investors, we want to be investing in high quality assets. We want to be hedging our positions in hard assets. And we want to keep a little bit of powder dry so that we can take advantage when the market does the wild thing and swings from basically highs and lows, and we can buy great companies at better prices. So with that in mind, let me just point out a couple of thoughts that concerning this whole issue of valuations and why we need to be careful and we need to proceed with caution and be careful with money. First slide really deals with the whole issue of stock market capitalization. So this is all the publicly traded companies in the United States. Their value as a percentage of the total GDP in the United States, which would be the value of goods and services produced in the United States. This chart goes back to 1958, and it shows that for many, many years, the total value of stocks traded in the United States was well under 100% of GDP. And that's a measure that Warren Buffett often looks at as just one of many factors in terms of valuation. And you can see that it did poke up to about 100% in the late 60s, and then it didn't rise to that level again until the well into the 1990s. And then we got way above that in 2000 with the tech bubble. We got up to 183% back in 2007 with the housing crisis. And today we are actually well over 200%. And so the reason we point this out is it means that stocks as a percentage of the GDP, the publicly traded stocks that is, are not cheap. And so, again, this is one factor that we look at. It's not the only factor, of course, but it's a factor that should cause us to be cautious. The second slide deals with the whole issue of share repurchases. And also on this slide, you have dividends. But our focus here really is on share repurchases. And that is when companies buy back their own stock. They use their cash flow, or in many cases, which is concerning, companies will borrow money and leverage up their balance sheet and just buy back their stock. Now, if you look at this chart, you can see that the red line just tracks the value of the S&P 500, so the stock market index. It's really the blue rectangles or the blue sections of this chart that I want you to focus in on. You can see that those are the value of share repurchases, the value of stock being bought back by corporate America. It reached a peak back in 2007, which you might remember was also a peak in the market at that time, and companies love to buy back their own stock when the stock is high, not low. And you can see that that's also occurring today in 2014, that companies are buying back their own stock again, and in record quantities reached $160 billion in the first quarter of 2014. So this is something that we watch, we're concerned about, because companies are the worst buyers of their own stock, and I'm speaking here in general. And there's a huge conflict of interest. Many CEOs are compensated based upon their stock price, and therefore, if you can buy back your stock and put your stock price up, hey, you make a little bit more money. But is that actually the best use of your cash? What about investing in the future? What about doing acquisitions? What about expanding your business and creating a larger moat around the products and services that you offer? That would be a far better use of cash in most cases. The next slide, the third slide, just highlights a few more points to do with stock repurchases. And in this slide, you can see, again, there's a blue line and a red line. And the blue line makes reference to the left side of the chart, and the red line makes reference to the right side of the chart. So if you follow the blue line, that's the amount of money that companies are spending buying back their stock. As I just pointed out, back in 2007, it reached a peak around 160 billion a quarter. We're over that now, or at least we were over that the first quarter of this year. And but the other line, the red line, is the impact that has, or the percentage of those share repurchases as a percentage of the total volume of stock that's traded on the stock exchange. And we find this very interesting, because back in 2007, that 160 billion that was going into stock repurchases represented about 4% of the trading on the market. When you fast forward to today, that 160 billion that was repurchased by companies in the first quarter of 2014 represented over 8% of the volume on the stock market. And you might be saying, isn't volume going up? No, volume actually is going down on the stock market. And so it's interesting that the importance of share repurchases is double what it was back in 2007. When you think of it as a percentage of stock volume or trading volume on the stock exchange. So this, again, is something that we worry about. We look at and we say companies are not very good purchasers of their own stock, number one. And number two, stock repurchases is a very large portion of the trading that's going on in the market. So if that were to disappear or go away, if companies were to become more conservative, certainly you'd think valuations would come off. And so we want to be careful. The fourth slide deals with margin debt. And as many of you might be aware, there are many investors who go out and borrow money and then buy stocks. And so this is something that we watch. So this chart actually goes back to, again, mid-90s, and the red line tells you the actual margin debt, and it makes reference to the left side of the chart, and then the blue line is talking about the valuation of the stock market itself. And you can see very clearly that as margin debt goes up, stock prices go up. Makes sense. More demand for stocks, stock prices go up. As margin debt comes off, people must be selling. They maybe have margin calls. They have to get out of their share purchases. Valuation of stock market drops. And so we're watching this. You can see that margin debt just peaked out just a couple of months ago at a record, higher than it was in the tech bubble, higher than it was in the housing market crisis in the United States. And it's starting to come off. And when margin debt starts to come off, it's often an indicator that the market might be settling back down and valuations might be becoming more attractive. So again, something that we watch and keep an eye on. The fifth slide is just an issue that talks to the domestic corporate profits as a percentage of GDP. And on this chart, you can see that the percentage of corporate profits, corporate profits as a percentage of GDP is at a record level. It's well over 10%, which is a very high number historically. But you can also see that typically when consumers are spending a lot of money and that's growing at a fast rate, that's the green line, the rate of consumer spending growth, that often feeds corporate profits. This time around, corporate profits have been growing and consumer spending has not been growing that much. Partly because of an aging population, partly because consumers already have too much debt, partly because the job situation is not great. Some of the best jobs have gone overseas. There's a whole host of factors. But when we look at this, it does tell us that it's going to be pretty hard for companies to continue to cut their way to higher profits and just buy back stock and not invest in the future. That's not a long-term prognosis for growing profits, and therefore profits as a percentage of GDP is probably pretty close to its high, and it's going to be harder for companies to grow their profitability going forward. Now, that's a general statement. We clearly are trying to look for companies that can grow because they're better run, they're in better segments of the marketplace. But in general, it means that the stock market is probably, in terms of corporate profitability, at a pretty high point. The last slide, which I find very fascinating, having been in the business now for almost 25 years. Whenever you get to a cycle where stock markets are high and everybody's enthusiastic, private companies tend to go public. They tend to sell a portion of their business because they can get a great price. I mean, if you're going to go public, you want to go public when everybody's excited about the market. So when you look at this chart, it lays out the S&P 500 at the top of the chart. You can see that it's doing very well. And then below that, you can look at it's a very jagged line. It goes all over the place, but it's talking about the share or the percentage of IPOs, that's initial public offerings, new private companies becoming newly minted public companies. You can see that this is monitoring the percentage of those companies that have negative earnings. In other words, they make no money. And we just reached another high point again just recently. Over 80% of the IPOs and new companies coming public make no money. And so again, this tells you there's a lot of froth. Be careful. Again, any one of these slides that I've pointed out to you is not a standalone slide. It helps paint an overall picture of being careful, being cautious, buying high quality, and being very attentive to price. If you have any questions at all, please feel free to call, email, and I trust your summer is going well and continues to go well, and blessings on the remaining month and a half of our summer. Thank you very much. Bye now.